Analysts. I'm Julie Hyman. We are 30 minutes into the U.S. trading day, so let's get to the three market catalysts we're watching this hour. First up, we'll have full market coverage ahead as the S&P 500 index hits 7,000 for the first time. Plus, we'll bring you the Fed Day decision guide as the central bank makes its first rate announcement of 2026. And a battleground stock gets set to report. Palantir, due to release earnings on Monday, will give you the case for and against buying going into those numbers. All that and more coming up on Market Catalyst. Let's get a check on what's going on in markets today. We got a mixed picture going on. The Dow little changed, off by about 7.5 points. The S&P 500, though, is pushing to that record. It's not there at the moment, but it did touch above 7,000 earlier in the session here as we sort of got underway, and then came back down below, still up by about 0.25%. The Nasdaq Composite up about 0.5% today. A lot of interesting moves going on elsewhere outside of stocks today too that we have to check on. It's worth checking on the 10-year as we go into the Fed decision, even as it's not expected that the Federal Reserve is going to change rates, but will the odds of further rate cuts change as we hear from Jay Powell today? Potentially 4.25% is where we see the 10-year right now. If you look at the year-to-date movement there, you get some gyrations. It's moved a little bit higher, even as we still have the outlook for rate cuts this year, which is interesting. We continue to watch action between the dollar and the yen. We continue to see the dollar fall versus the yen year to date, a tiny bit of recovery here today. Also, we'll be watching Bitcoin around the Fed's decision. It did go above 90,000 recent days, but since then has come back down a little bit. And of course, gold continues to be in focus here as we have seen the big increases in gold prices. But digging a little bit more into stocks, just want to mention here that we are seeing today consumer discretionary and tech help lead here, industrials lagging. It has been an interesting push to these new highs because over the past couple of days, we've seen tech come back, but for year to date, that, of course, has not been the case. We've had communication services is here, tech is here, but it's been energy, materials, consumer staples that have been the best performers year to date. So that has been a pretty significant switch. And then finally, we do have, going back to the intraday here, we do have some companies reporting after the bell today within the tech complex. So we'll continue to watch how that affects tech overall. Amazon getting headlines today as well because it is cutting 16,000 more jobs. Well, the Federal Reserve kicking off its first meeting of the year. Wall Street expects the Fed to keep rates on pause, but it's what's going on behind the scenes that will likely take center stage. Joining us now, Christian Hoffmann, Thornburg Investment Management, head of fixed income and portfolio manager. Christian, so, we're not expecting any movement on rates today. So where are the fireworks going to come from if there are going to be any?
I think this administration would have loved to roll out a successor to Powell right around this time, perhaps concurrent with the announcement today. But we continue to watch prediction markets and continue to see, a lot of volatility with, Powell's, proposed successor with, Rick Rieder recently surging in the polls and then, having some pushback more recently. I think what the administration is really struggling with is finding someone that is both fiercely loyal to Trump, but also viewed by the market as wildly independent. Those two things are not necessarily, sympathetic to each other. And I think there'll be some more twists and turns here. Again, we've been talking about, call it 2 to 5 candidates, but again, maybe the administration is going to need to look deeper. And again, I don't think we're done here.
Well, does that candidate exist anywhere, Christian?
Like, I think it's a bit of a unicorn. And the good thing, and I think the thing that reassures us is, the proposed candidates largely have been, I think, people with legitimate backgrounds and people that we believe, would be worthy successors to Powell. As it relates to the meeting today, I think the two things that we're focused on are, one, do we have more dissents besides Mirren? I think, that could be interesting. And then two, does Powell, decide to poke the bear and get into politics? Historically, he has not. There'll be a lot of thirst from the media to see that happen, but Powell has been, I think, pretty wise in being, unwilling to poke the bear, so to speak. And I think that continues today.
What do you think? I asked this of a guest earlier, and I'm curious your take. what the market reaction will be if it is, say, Rick Reeder, or if it is, say, Kevin Warsh.
I think the market feels fine with that, and you've seen a market test of these things. I think the administration has been wise to float things out and actually see the response, to get some back channel, conversations to really market test these things. So I actually feel fine with that.
Okay, so Christian, let's then get to actual what's going to happen with rates this year, right? And we're seeing either 2 or 3 as sort of the consensus. What do you think is going to happen? And will that outlook change substantially if there is a different Fed chair, or when there is a different Fed chair?
So most likely we've seen the last of cuts during Powell's oversight of the Fed. He has 3 more meetings, and we're not likely to see any changes in any of those meetings. So I would think of it less of what do we expect for the year, and really think about more uncertainty around the back half. One, because the economic outlook is likely to look quite a bit different 6 months from now than it is today. And 2, because we're going to have different actors really pulling the strings. So I think, 0 in the first half is very likely, but I think the likelihood of having more cuts in the back half is probably higher than the market expects right now. So market expectation is for 2 for the year. I think we could see 3, and I think that will most likely be, weighted towards the back half. As you think about the interest rate picture more broadly, one of the interesting things is if you look at the 10-year, we had roughly 85 basis points of swings and volatility. That's actually a lot of volatility that you're introducing to client portfolios. That said, if you look at the quarter ends actually looked very much like they do today, right around this 420 area. So it feels like this is something of a neutral habitat, or something that we're gravitating to, but it doesn't mean that you don't want to be active in markets and taking advantage of some of that volatility.
And aside from the Fed, of course, geopolitical events have had, an effect on the market, even if fleeting at times. So do you think that sort of 420 level-ish will be consistent, given that we got a long year ahead of us, Christian, for a lot more headlines?
Look, I think this year will actually have more volatility, than the previous year. If the, 3 big things that we're thinking about, we need the AI bubble not to pop. We need the labor market to hold in there, and certainly we have some trepidation about that. And we need the market to remain, have a sanguine response function to geopolitical volatility, which, in just 3 trading weeks, has not been minimal. In a variety of hotspots and very interesting developments really around the world.
And what happens if those things don't happen?
If they don't happen, look, the old cliche in fixed income markets is for strategists to call for a coupon year. It's very easy to do that. It kind of says things are efficiently priced.
What does that mean, a coupon year?
A coupon year means there will be no change in rates or no change in spread, or somehow they will offset, and the year will end very much like it began, and you will clip your coupon for the year. You see strategists call for that almost every single year, and you see that come to fruition almost never. So that old cliche remains intact. And we're looking for volatility this year, which we hope to take advantage of.
Gotcha. What's the best way for retail investors who are trying to watch fixed income for them to take advantage of that?
Look, unless you're sitting in front of screens and trading bonds and have access to being able to trade large blocks of bonds and engage in primary markets, it's really, to turn it over to professionals and to really outsource to folks doing this, 12 hours a day and, fully engaged in the markets. I think the value of active management in fixed income remains non-controversial. And again, you can look at our track record, and I think it speaks for itself.
Christian, thanks a lot. Appreciate it.
Thank you.
Coming up, the 3 trends pushing ETF investors to once again break inflow records. That's next on Market Catalysts.
Welcome back to Yahoo Finance. I'm Brooke DePalma. Let's turn now to some of today's top analyst calls on Wall Street. We're watching Texas Instruments, Circle, and Johnson & Johnson. First up, Texas Instruments. Multiple firms raised their price target on the stock, including Barclays, Susquehanna, Benchmark, JP Morgan, Mizuho Securities, and Bank of America. This comes after the chip maker gave an outlook that saw improved demand. The average price target on the street is now around $219. Next up, Circle. Mizuho upgraded its rating on the stock to neutral, and price target also got an upgrade to $77. The analyst said since all polymarket bets are settled in the crypto stablecoin USDC, and now sees that as a looming catalyst, but remains on the sidelines as rate cuts, rising costs of distribution, and intense competition from other stablecoin players like Tether. That's the reason it remains neutral. Now keep in mind there are about 15 buys, 11 holds, and 2 sell ratings on the street. Last up, Johnson & Johnson. Morgan Stanley upgraded the stock to overweight from equal weight. The analyst said its commercial momentum is quote, too hard to ignore, and it expects new products to drive a beat on earnings. The analyst also raised its price target on the stock to $262, up from $200. The average 12-month price target on the street right now is $232. There are now 18 buys, 12 holds, and 1 sell rating on the street. But keep it right here on Yahoo Finance because we'll be tracking all the market moves and top calls throughout the session.
ETFs have already taken in more than $100 billion this year. That's on pace to smash the all-time January record of $88 billion set last year. For more on what's behind this growth, I want to bring in Todd Rosenbluth, TMX Verify Head of Research for this week's ETF report brought to you by Invesco QQQ. Good to see you.
Great to be here.
So, $100 billion. It's actually more than that by now, isn't it?
It is. So that was when I wrote my note at the end of last week. We're approaching $125 billion. So you're right. We haven't closed the month, so it isn't higher than what we saw last year. But really strong demand sets the stage well. We had a record $1.5 trillion in ETFs last year. It feels like maybe that's the new floor. That's the new normal, which would be a great thing for investors and, of course, the ETF industry.
So what's going on this January? I mean, because it's been a January that has been seeing a lot of tape bombs, as they call it, like a lot of headline risk, a lot of volatility. Is that what has that driven people into ETFs?
So it has, and some of the areas that we've identified are closely related to that. So, for example, active fixed income ETFs. They were very popular last year. 40% of all fixed income flows went into active fixed income ETFs, and that trend has continued. We've seen PIMCO's PYLD, we've seen BlackRock's BINC, I guess that's an iShares named product. We've seen Fidelity have some success with its total bond ETF. Given the volatility that's happening in the fixed income markets and the uncertainty, even though many people expect the Fed to do nothing today, and perhaps in the short term, there's still a lot of uncertainty, you turn to an active manager when you're looking for that. And that's actually one of the topics we're going to talk about at the Exchange Conference, active fixed income ETFs gaining ground.
I'm curious then, is the driving factor behind active fixed income ETFs mostly institutional money versus retail investors?
So it's a combination. And so I guess institutional in that maybe we're talking about advisors or people who are running model portfolios. Mm-hmm. We are seeing them increasingly turn to active fixed income ETFs to choose where they want to have the exposure. But the trading that we're seeing in small amounts for active fixed income ETFs also shows a positive sign. The Fidelity Total Bond ETF is one of those products, very popular on Fidelity's platform based on the data that we've seen.
Interesting. Okay. And then another area here is thematic ETFs, which, I mean, are kind of a stalwart, right? But are there different ones that are sort of driving that demand right now?
They are. So for the last 3 years, we've really seen artificial intelligence focused ETFs be very popular, and that's a trend that people still believe in, and we at Verify still believe in. Mm-hmm. But we've seen some of the products that are the leading ones out there, like iShares BAI, which was very popular in 2025. It's only received more modest inflows. What we've seen is that the more defense-focused ETFs, so Global X has a defense technology ETF, SHLD, which was popular last year, a little bit under the radar because it's not AI specific. It's been very popular this year given the geopolitical tensions. And there's a new ETF, the Rex Drone ETF. The ticker is DRNZ. It just came out late last year. It already has 60 million in assets, which is relatively good for a new ETF, but it's up almost 30% for the year. So investors that have gone into this ETF have been rewarded we think that's a theme that many people are going to pay more attention to as the year progresses.
Interesting. Okay. And then something that we talk about a lot here with Markets Guest is the broadening, right? And I assume that that's happening within ETFs too.
It is. So these were products that are outside of the S&P 500 or not specific to the S&P 500 or the NASDAQ 100 that were unpopular last year. So Invesco has the S&P 500 Equal Weight ETF, RSP. It was among those large ETFs that bled money in 2025. It's actually the third, I believe, most popular ETF this year in terms of net inflows. So investors are buying into that diversification and getting the S&P 500, but all of the stocks. And so you don't necessarily have as much exposure to Apple and Microsoft and NVIDIA. You have the other stocks. The other one that caught our eye is the Financial Select Sector Spider ETF from State Street. I actually changed the name, and there's a lot more words in the front of it than I'm forgetting right now.
We're talking the XLF.
XLF.
Yes. Okay.
Yeah, so
easier to just say XLF, right?
And so yes. So XLF also bled money last year. It's been very popular this year, a top 10 asset gatherer. So people are looking outside of the technology or the communications services sectors, and financials has been one of those beneficiaries.
Something else, Todd, I'm interested in, as you've been talking, when you were talking about tech and you said that AI ETF, BAI, is seeing smaller inflows, but you didn't say outflows. And you've been talking about all these things that saw outflows last year. In January, does anything stand out for actually seeing outflows, or is it just mostly characterized by smaller inflows in certain areas?
So, well, we've had a great start to the year. So there are some products that are seeing outflows. So even though small cap ETFs have been, some of them have been in favor. Small cap ETFs have performed well. The iShares Russell 2000 ETF has been bleeding assets this year, and we've seen investors go towards some higher quality exposures towards small caps. So the iShares S&P 600 ETF, IJR, has seen some inflows. Avantis has a small cap value ETF that's seen inflows, that's actively managed. And then there's a more modest flows going into a higher quality small cap ETF from Victory Shares. The Victory Shares small cap free cash flow ETF, SFlow. So we are seeing investors, they're either rotating within a certain investment style, but many things are doing well. This is on pace to be another record year.
I have sort of a bigger picture ETF explainer question for our viewers here as we talk about inflows and outflows. Now, even if something has inflows, it doesn't mean the price goes up. Even if something has outflows, it doesn't mean the price goes down, right?
That's correct.
And small caps are just one example of that. Can you explain that to people when we talk about inflows versus price?
Sure. So money going into an ETF means that the ETF asset manager has to go and buy some shares the way that you might think of. A lot of the trading that happens within the ETF ecosystem, I'm selling and you're buying, and that trades and those paths connect one another, and it doesn't impact the overall ETF. But what we are also seeing is that ETFs, even as they're growing in size and scale, 1.5 trillion as I keep referring to last year, most of the money that is tied to individual stocks is outside of the ETF wrapper. Either people are owning individual stocks, people are owning stocks through a mutual fund wrapper. So the demand that we're talking about doesn't necessarily mean that ETFs are in favor, and there are ETFs that are up in value this year that have seen outflows.
Right.
Silver ETF, for example, a lot of trading happening within that ETF in SLV that happened this week. It's up really strongly, but people are taking some profits in the ETF because it's done so well.
Gotcha. Okay. That's an interesting example, and that is one that has seen a lot of activity along with GLD and some of the other precious metals ETFs.
Yeah, commodity ETFs there's only so many things that we can talk about, but commodity ETFs have been very popular this year also.
It seems like a lot of things have been popular. Todd, thanks so much. It's good to see you.
Thank you.
Coming up, we're looking at some of today's top trending tickers. Stay tuned. You're watching Market Catalysts. Now time time for some of today's trending tickers. We are watching AT&T, C3AI, and Qorvo. Markets and data editor Jared Blickery is joining me. And first, I want to talk about AT&T. It reported fourth quarter profit and revenue that beat analyst estimates. And Jared, I had the chance to talk to the CFO, Pascal Desroches, and we talked about how the company is trying to push its subscriber base higher. And basically, it is really emphasizing packages. In other words, you buy wireless and broadband, and they increased their numbers there. So 42% of people who have fiber from AT&T also now subscribe to wireless.
Yes, and it's always about all those promos that they can put together and how much are they going to discount. So it looks like they're being disciplined so far. Yes. That's the analysts speak for, well, they're not cutting or giving away the farm. But this quarter was really about buybacks and dividends. You could call it the show me the cash quarter. And so here we got fourth quarter free cash flow of $4.2 billion. They have a new free cash flow outlook for next year. That's 2028, $21 billion. So they're aiming to return $45 billion to shareholders from this year, that's 2026 to 2028. And I got some commentary. This one's from Scotiabank. They rate the stock sector perform, price target $29.50. The company was supported by good tailwinds from the now large fiber network base. And from that base, you get to offer everybody new products.
Right.
And then vital knowledge. The results and guide are decent, and the 10% annual capital return forecast for the next 3 years is healthy. And that gets back to all those buybacks and dividends. And real quick, if we just go to the Wi-Fi Interactive, I will show the chart here. This is what's happened year to date. And you can see still just a little bit underwater. Let me just give you the longer term look. Here's 5 years. You can see had a kind of a lift off in this bull market. Started a year later than most of the other stocks, but that is a nice run up there. And then over the long term, this is typical of a telco. This is a lot of sideways trading action over the last, 30 years here, going back to 1995. So that is kind of typical because they give away so much of their earnings in dividends.
Right. That's why even though it goes sideways, people sometimes
Exactly.
hold on to telecom stocks.
To.
Something else I wanted to mention that I talked about with the CFO is a couple of big acquisitions that they are about to close and going to be integrating. One is a company called Lumens. The other is EchoStar. And so Desroches talked about that they ended 2025 with accessibility to 32 million homes, and they expect by 2030 to push that to over 60 million. And what he pointed out is when Lumens had access to many of those locations, that their penetration was at about 25%. So that's how many customers actually sign up as opposed to how many could sign up. And he said their penetration numbers tend to be higher. They do different marketing. They offer those bundled deals with the wireless, for example. And so he expects to see some upside, continued upside to people who have some of those package deals. By the way, you mentioned the word disciplined.
Yes.
He used that word too when
right.
talking about the fourth quarter and those wireless discounts, that they were more disciplined than they had been. And the number of wireless subscribers actually missed analyst estimates a little bit. He did not seem concerned by that as a result of the disciplined approach. Next up, let's talk about C3AI. That company is gaining on reports from the information on a potential merger. The shares right now up by about 4%. There have been reports in the past that it might be up for sale. Now we're getting a report of a particular suitor potentially.
Yes, so this would be this suitor in particular, Automation Anywhere. So let me just tell you, kind of back up here, what does C3AI do? They have that ticker AI. So this has been on investors' radar for a long time, but the stock has had some trouble over the last few years. So C3AI is a software company that sells AI tools for big organizations so they can use your company data to predict outcomes and run operations better. Automation Anywhere, the tile company, is a leader in robotic process automation, or RPA. This is software bots that do repetitive computer tasks that usually people do, but this is simple stuff like copying, pasting between systems, might be moving data, filling out forms. And so you put these two together and you're thinking, okay, we're going to have potential synergies here. However, I got the reaction from Bloomberg, kind of their hot take. They don't see the synergies right away. And so I don't want to use the word desperation, but there's a lot of pressure in the industry to do something, and this might have been a slightly hasty decision if I'm reading through to this properly.
I mean, although the shares are up by about 4%, I mean, to take another step back and sort of give some context to the company, Tom Siebel is the person who founded this, who also founded a company called Siebel Systems. Basically, he is an enterprise software and technology veteran who's been in the game for decades. However, he stepped away from C3 last summer because of some health issues, and that's what then threw the future of the company into a bit more question. It has a different CEO now, obviously. So we'll see what happens. I see you got the chart up there.
Yes, if we go to the Wi-Fi Interactive, I have a max chart on. So this goes all the way back to their 2021 or late 2020 debut. And you can see it's just been going sideways over the last few years. I'll do a 3-year chart, and you can see, yes, it is 26% down. So it was in a trading range, and it's broken the trading range, hence the pressure on the company, at least by the shareholders.
Yeah. All right. Let's talk about it. Last one. Qorvo. It's an Apple supplier that reported an outlook far weaker than Wall Street had been expecting. And we watch this one closely, even though it's not a household name, because it is an Apple supplier.
Yes. Yeah, they basically get about half of their revenue, 47% from Apple. And here's the money line from the report. Our March quarterly outlook reflects the seasonal decline at our largest customer, which is Apple. And so Qorvo is a company that makes kind of the radio guts in these phones, and Apple phones and a few others, cellular, Wi-Fi, GPS, Bluetooth. And so if Apple is stumbling, well, Qorvo might actually fall. And the hot take here is this reads like a handset demand plus customer mix pain, not just suddenly like Qorvo forgot how to execute. So there are some larger forces at work here. And here's the number line here. Guide calls for $775 million to $825 million in revenue and $1.05 to $1.35 adjusted EPS. Street was looking for higher than that. And so Piper flagging this potential share loss in a key component area for upcoming iPhone models. So just kind of a look ahead to the future there.
Yeah, although reading through some of the other Piper comments and some other analyst comments, it seems as though it's a combination of potential weaker handset demand, but also it sounds like Qorvo is exiting its lower end Android business.
That too, yes.
And so that's having an impact. So it's not a straight line to Apple demand here. It seems like it's a little bit more of a complicated picture in this particular quarter.
Good news is once they exit the Android business, because that is low margin, they will have taken the pain and potentially the things open up from there.
We shall see. Thanks so much, Jared.
Thank you.
Coming up, it's tax season. We explain the changes you can expect when you file your taxes in the coming weeks, or hopefully the coming weeks for you, not later. That's next on Market Catalysts. Tax season officially kicking off this week. Yahoo Finance's Josh Lipton spoke to Tom O'Sabin, the director of tax content at the National Association of Tax Professionals, about some tax filing myths.
Tom, it is great to see you. So let's get to some myth busting here, Tom. Start with a big one, a classic. Does filing early get you a bigger refund, Tom? True or misconception?
Misconception. You know, there are lots of people out there that say when you file early, that's when the Treasury has plenty of money. Busted. No, there is no connection to filing early and getting a bigger refund.
How about this one, Tom? This one's going viral, you say. How about this one? Is it true that if I form an LLC, Tom, I automatically get tax write-offs?
Busted. Another one. You know, just forming an LLC, you might do that for your business, but you're going to have the same business deductions on whether you've got an LLC or a traditional sole proprietorship or a corporate entity. Filing an LLC is not going to get you some additional write-offs that you wouldn't have got anyway. So we're 2 for 2 in the busted category.
How about this one? Here's one I'm sure would interest some viewers. Can W-2 employees, Tom, can they take a home office deduction if they work remotely?
Also busted, but busted after 2017. The Tax Cut and Jobs Act eliminated unreimbursed employee business expenses, and that's really where the bust came from. Prior to 2018, if you in fact would work remotely from home, for example, you could in fact deduct a home office as an employee. In today's world, busted, that's only available for self-employed people. Point to take, if you're working from home and you've got expenses you incur, submit those expenses to your employer for reimbursement.
Here's one. This is interesting. Is it accurate, Tom, that if I don't get a 1099, my friend, the IRS doesn't know about the income.
I have to laugh at that one, and I'll also bust it. I've been at this for 35 years, and the number one thing that a taxpayer says is, I didn't get anything. So if I didn't get anything, I don't have any income to claim. Busted. The IRS is aware of the income, and in today's world, one of the reasons taxpayers may not have received anything is because they have actually elected electronic distribution for those items or electronic contact. Just because you didn't get something in the U.S. mail doesn't mean you don't have income. And just because you didn't get a tax document, the tax law says anything of value is in fact taxable. So no 1099, no tax, busted.
Tom, how common are audits? I ask because I bet a lot of people think, you know what, they're not common. They're rare, they're unusual. Is that true?
Absolutely it is. And I'll go off of my experience again. You have a likelihood of about 1% to 2% of American taxpayers are audited. And the numbers are even smaller if you are in fact a business. But the fact of the matter is, I guess it's sort of like being out there on the freeway, and if you see the state trooper, it'll cause you to slow down. The auditors are out there. They have algorithms that they use to test returns to see if that needs to be challenged, if it falls out of the realm of possibilities of what should be. So the auditors are there, but the likelihood of audit is still very, very small.
What about, Tom, no taxes on tips and overtime? I was just talking to my colleague Emma Ackerman about this, and she was saying, it maybe is not as simple as that headline suggests. What do viewers need to know?
You are absolutely correct. First of all, and including the forms that the IRS came out with, it says no tax on tips, no tax on overtime. But just as your previous guest said, that's not exactly correct. There is a deduction for tips. There is a deduction for overtime. But there are calculations that go into play. And as was mentioned previously, there's also income limits and also income phase-outs. So there can be a deduction for taxpayers, but it is not a circumstance where, hey, don't worry about your tips. Don't worry about your overtime. It's all tax-free. It's more complicated than that.
What about the new rules for 2025, Tom? I don't know if you saw this. The Journal had a good write-up on here, and they talk about increased SALT deductions, new tax break for seniors, a lot going on here. I mean, is it possible, Tom, to say, in your opinion, okay, this is the most important change, or the two or three most important that you would put on people's radar?
I think we'd start with, and those are good questions, the SALT limitation, which stands for state and local tax. With that being increased from $10,000 to $40,000, and we've been at $10,000 since the Tax Cut and Jobs Act came out in 2018, many people were not able to itemize deductions. With that increase to $40,000, I think there's going to be some impact for people, especially in high tax states. I'm coming to you from the state of Illinois. We have high property taxes. More people, I believe, are going to qualify to itemize. I think that's going to be an important takeaway too. And you also mentioned about the senior deduction. One of the myths out there, you hear it almost every day, is that the new One Big Beautiful Bill Act made Social Security benefits non-taxable. Not true. What they have brought actually is a senior deduction. You just have to be age 65. If you're age 65, there's a $6,000 deduction. It's a separate deduction. It's not part of the standard deduction, not part of itemized deductions. If you have a married couple filing jointly who are both at least age 65 at the end of the year, each one has a $6,000 deduction. But like other things, there is an income phase out.
Finally, Tom, listen, you've been doing this a long time, as you noted. For this tax season, Tom, is there any kind of just common big mistake or mistakes over the course of your career you've seen people make that you would say, listen, don't do this, avoid this?
I would say, I'll talk about from taxpayers in general, as opposed to those who come to a professional. If you're going to do your taxes yourself, which you can, I would say use software. Use software because it's going to eliminate those errors that you're just describing that people have made for many, many years. Math errors, putting the wrong social security numbers on returns, forgetting to include income. Use some software and also use direct deposit. It'll take some of those simple errors and the human error part out of it, and you'll get a better experience in filing your return.
Tom, great to have you on the show today. Great advice. We appreciate it.
Great to be here.
Let's go live now to Washington. Our Jennifer Schonberger standing by with Texas Senator Ted Cruz. Jen?
Thank you, Julie. Senator Cruz, thanks so much for joining me today here at the Trump Account Summit in Washington. We know that these Trump accounts are going to be rolled out on July 4th, $1,000 per every child born, but only for children during the duration of the Trump administration's term. Does Congress, do you see a way to codify this, to extend this?
100%. So I drafted the provision, the Trump accounts, and when we wrote it during the process of reconciliation. It was part of the working families tax cut that the president signed last 4th of July. And I think it may well be the single most important part of that bill because it is going to transform every child in America. Every child in America, number one, is going to realize the benefits of compound growth. And every child in America will have an investment account opened for them. Parents, employers, family can give $5,000 a year. That grows in a tax-advantaged account. But critically, that account is invested in the stock market. It's invested in the S&P 500. So, look, if you assume, let's say a little girl is born this year. She'll have an account open for her. That account will automatically be seeded with $1,000. And if her parents or family or employer puts $5,000 a year, if you assume that account grows at the historic rate of growth of the S&P 500, which is 7% a year after inflation, by the time that girl's 18, she'll have $170,000 in that account. And if she keeps contributing to it, by the time she's 35, she'll have more than $700,000 in that account. And that's not just the kids of rich people. That's the kids of a single mom waiting tables. You want to talk about changing the entire country, but secondly, this is what I'm really excited about. We are going to be creating a whole new generation of capitalists because every kid in America is going to be an owner of the biggest employers in America. So if you imagine 10 years from now, a little boy will pull out his phone, and instead of thinking big, scary corporations, instead of thinking, gosh, capitalism is terrible, that little boy will look at his phone and say, hey, I own $100 of Apple. I own $75 of Boeing or $50 of McDonald's. And suddenly our kids have a stake, an ownership. That is exciting. You're right, the way it is written, it is for a few years. I think it is 100% that Congress is going to extend this program and make it permanent. When I drafted it, that was absolutely my intention, to have this be a permanent and transformational program.
To your point, you said children are going to be able to pull out their phones and say, I own $100 in Apple or McDonald's or whatever. And we know that these dollars are going to be invested into the market. But we also know that a lot of these children growing up and a lot of Americans don't have the personal skill set to invest. So we know that American history is mandated in schools. Why not mandate at a federal level investment classes for middle schoolers and high schoolers so they have the tools, especially once they turn 18, to know how to manage their own money?
So I think the right place to do that is at the state and local level. I don't want the feds mandating curriculum. I don't want Washington deciding what curriculum your kids are taught, what curriculum my kids are taught. I think that should be at the state and local level. I think you're seeing a lot of state and local levels saying financial literacy matters. We're going to try to teach our kids. And one of the great things about these Trump accounts is they're going to be a natural vehicle for teaching financial literacy. Again, in second grade, the teacher will be able to say, oh, okay, everyone, pull out your phone and look at your Trump account. Look at what you invested originally, look at what's been invested over time, and look at the growth. And suddenly the stock market isn't just sort of strange numbers that sometimes appear at the bottom of a TV screen. Suddenly the kids are like, wait a second, look at this grow. And I think what you'll also see is you'll see kids as they get a little older saying, you know what, for my birthday, instead of giving me some toy I don't need, maybe you can give me $50 or $100 in my Trump account.
Well, that would be nice, have some stock.
Yeah, like that, the ability to think like investors, this will naturally prove financial literacy. And when you're an investor, it changes the way you view the entire economy, the entire country.
Switching gears, Senator, Democrats in the Senate are furious over what's been going on in Minneapolis. They are threatening to have a partial shutdown of the government later this week. How do you see things now? Are Republicans willing to give any consents do you see coming to the middle at all, or are we barreling towards a partial government shutdown at this point?
Look, I think it is very likely that the Democrats are going to force a government shutdown. We saw a couple of months ago the longest government shutdown in U.S. history. Chuck Schumer and the Democrats forced that right before Christmas, and they did it really because they wanted to throw a temper tantrum, because they were mad and they wanted to show their left-wing base they really, really hate Donald Trump. If you look at immigration enforcement, one of the big reasons President Trump got reelected is the Democrats spent 4 years with open borders, and we saw 12 million people invade this country. My home state of Texas was on the front lines of that invasion. We are now seeing the president, number one, in terms of securing the border, do you know that illegal border crossings have dropped more than 99%? I mean, it's staggering success. And I got to say, I don't understand it. My Democrat colleagues have decided they are the party of illegal immigration. They are the party of the violent criminals and the gangbangers that they released, of murderers and child rapists. And I think it's really unfortunate. I think we are very likely to see a shutdown.
How long are we looking at, though? Is it at 45 days again?
It certainly could be. It's up to Chuck Schumer. I mean, the way the Senate works, you have to have 60 votes to fund the government. We only have 53 Republicans, which means we cannot pass this without at least 7 Democrats. The reason we had a 43-day shutdown is the Democrats wanted to throw a temper tantrum. Remember, Schumer is really afraid of being primaried. He's afraid of being primaried from the left. AOC is in New York. She's breathing down his neck. And so he's trying to appeal to the really angry left-wing activists. I think when it comes to ICE, the Democrats have decided, they're very explicit. They want to abolish ICE, which is to say they don't want to enforce immigration. They don't want to deport criminals. They don't want to deport gang members. Look, we saw one of my colleagues fly down to El Salvador and have daiquiris with an MS-13 gang member who's being prosecuted for human trafficking. It used to be a bipartisan agreement we should lock up criminals, and I think it's unfortunate the Democrats have abandoned it.
Really quick, Senator, before I let you go, do you think that Kristi Noem needs to go?
Oh, look, I like Kristi. I think she's doing a good job. I have encouraged the administration in terms of messaging. I think there are a lot of Democrats and a lot of folks in the media that are using what's happened in Minneapolis to try to change the narrative. And I think, listen, it is tragic when any American citizen is killed in an interaction with law enforcement. The 2 individuals who were killed were both actively impeding law enforcement. That's a dangerous thing to do. If you go and try to stop a police officer on the street, particularly if you're using a deadly weapon, there's a real risk of lethal force. But I think the tone in communicating matters. And so I would encourage Kristi and everyone else to focus really on, look, the people that are being arrested are really dangerous criminals. You're getting people who've committed horrific crimes that are being taken off the street. And I got to say, the protests in Minneapolis, they're not organic. They're paid for, they're organized, and they're designed. They're from the extreme left wing. They're designed really to foment chaos and violence. And I think every Democrat should ratchet down the rhetoric. You got a lot of Democrat politicians that are just throwing gasoline on the fire.
Senator, we'll have to leave the conversation there, but thank you so much.
Thank you.
That's Senator Ted Cruz. Julie?
Thanks, Jen. Appreciate it. Well, let's get a final check on markets here before we leave you. As we take a look at the major averages, we see them all turning into the green just barely. Remember, of course, we have a Federal Reserve announcement this afternoon, not expecting any kind of rate cut, but we should get some interesting commentary out of the press conference. That's it for Market Catalyst. I'm Julie Hyman. Keep it right here.